Many of us work tirelessly to earn money, but few truly understand the art of making money work for them. Instead of being a slave to your paycheck, it's time to shift your mindset and start thinking of money as a renewable resource, a tool that can multiply and grow when managed wisely. Let's get started. 10 smartest way to make money work for you. Number 1, think money as a renewable source. This involves adopting a mindset of abundance, investing strategically to generate continuous returns. What are the investments you should do that we are covering later in the video? To start, it's crucial to recognize that our mindset plays a significant role in how we approach money. One of the most powerful aspects of thinking of money as renewable is understanding the concept of compounding. When we invest our money wisely, we not only earn returns on our initial investment, but also on the returns generated by that investment. Many billionaires become rich of their abundance mindset, their capability to invest. Let's discuss this in our next point. Number 2, invest in an idea that you believe has potential. Successful investors often possess the ability to identify promising ideas early on, recognizing their potential for growth and disruption within their respective industries. Once an investor identifies an idea with potential, they provide financial support to help bring the concept to fruition. This support may come in the form of seed funding, venture capital, or angel investment, depending on the stage of development and the needs of the project. Successful investors often have a long-term vision for the ideas they invest in, understanding that building a successful business takes time and perseverance. They remain committed to supporting the idea through its various stages of growth and evolution, adapting to changing market conditions along the way. Often referred to as one of the most successful investors of all time, Warren Buffett has built his wealth by investing in companies that he believes have strong fundamentals and long-term growth potential. His investments in companies like Coca-Cola, Apple, and American Express have yielded significant returns over the years. Number 3, become a silent partner in a business. Investors that provide companies financial support but aren't involved in day-to-day operations and don't participate in management tasks. You contribute financially and share in profits, losses, but typically have no say in management decisions. The primary benefits of being a silent partner is the ability to earn investment returns with limited involvement and being in a position of limited liability for any financial obligations of the business. Back in 2011, just as Uber became popular, Jay-Z invested $2 million in the company. The car service company grew from a valuation of $300 million at the time to $66 billion. This is the power of investing. 4, invest in real estate. Many investors and successful real estate agents who turned millions in profits through buy and hold and flipping strategies. There are some options for real estate investing. Residential, purchasing single-family homes, condos, or apartments to rent out for passive income. Commercial investing in offices, retail spaces, warehouses, or industrial properties for higher potential returns. REITs. Owning shares in companies that own and manage real estate, offering diversification and liquidity. Investing in real estate can be a powerful way to build wealth, but it's crucial to understand the different strategies. 2 major strategies are: buy and hold, purchasing properties to rent out for long-term income and potential appreciation. Fix and flip, renovating undervalued properties and selling them for a profit within a shorter time frame. Number 5, open a high-yield savings account. High-yield savings accounts offer higher interest rates compared to standard savings accounts. While interest rates can vary depending on the bank and prevailing market conditions, high-yield savings accounts generally offer rates that are several times higher than traditional savings accounts. Personal finance expert Suze Orman frequently advises individuals to prioritize building emergency funds and cash reserves in high-yield savings accounts. Orman stresses the importance of having liquid assets available for unexpected expenses or financial emergencies. By taking advantage of higher interest rates and compounding returns, you can achieve their financial goals and maintain financial stability in both the short and long term. Number 6, peer-to-peer lending. Renowned entrepreneur and investor Peter Thiel, co-founder of PayPal and an early investor in Facebook, has utilized peer-to-peer lending platforms as part of his investment strategy. Thiel has recognized the potential of P2P lending to generate attractive returns while providing alternative financing options to borrowers. P2P lending platforms offer the potential for attractive returns compared to other fixed-income investments. Peer-to-peer lending provides investors with a source of passive income. With automated investing tools and loan servicing platforms, investors can earn income without actively managing their investments on a day-to-day basis. Number 7, invest in assets that will increase in value. As we discussed earlier in this video, many of us work tirelessly to earn money, but few truly understand the art of making money work for them. They invest in the decreasing asset. Investing in assets that increase in value allows investors to capture capital appreciation, or the increase in market value of their holdings over time. Investing in assets that increase in value serves as a hedge against inflation and currency depreciation. Renowned hedge fund manager Paul Tudor Jones has diversified his investment portfolio to include assets such as commodities, currencies, and real estate. Jones has a keen eye for identifying undervalued assets with the potential for appreciation, leveraging his expertise to capitalize on market opportunities. Number 8, invest in mutual funds. Benjamin Graham advocated for the use of mutual funds as a vehicle for individual investors to access a diversified portfolio of undervalued securities. Graham's investment principles, outlined in his seminal book, The Intelligent Investor, emphasize the importance of margin of safety, disciplined analysis, and rational decision-making in achieving investment success. Mutual funds pool money from multiple investors to create a diversified investment portfolio. Mutual funds offer cost-effective investment solutions compared to individual stock or bond investments. Warren Buffett has also recommended mutual funds as a viable investment option for individual investors, particularly those who lack the time, expertise, or resources to manage their own investment portfolios actively. 9. Invest in the market. The ultimate growth is to stay invested in the market. Investing in the market refers to participating in various financial markets, including the stock market, bond market, commodity market, and foreign exchange market, with the goal of generating returns and building wealth over time. Investing in the market allows individuals to allocate capital to a diverse range of investment opportunities, including stocks, bonds, exchange-traded funds, ETFs. Many stocks and bonds offer dividend income, providing investors with a regular stream of cash payments. Dividend-paying stocks and bonds can supplement investors' income and contribute to wealth accumulation over time. The power of compounding allows investors to reinvest their investment returns to generate additional income. By investing in a diversified portfolio of assets, taking a disciplined approach to asset allocation, focusing on long-term investment objectives, investors can harness the power of the market to grow their wealth and achieve their financial goals over time. Number 10. Get benefit of leveraging. Leveraging refers to the strategic use of borrowed capital to amplify investment returns or increase the potential for wealth creation. Leveraging involves borrowing money from lenders or financial institutions to invest in income-producing assets or investment opportunities. For example, if an investor borrows $100,000 at a 5% interest rate to invest in a property that appreciates by 10% annually, the investor's return on investment, ROI, would be 100%, $10,000 appreciation on a $100,000 investment, excluding expenses and interest costs. Donald Trump is known for leveraging debt to finance high-profile real estate acquisitions and development projects. Trump's real estate empire, including properties such as Trump Tower and Mar-a-Lago, was built through strategic leveraging of borrowed capital. By using leverage to magnify investment returns, investors can achieve higher levels of profitability and capitalize on market opportunities to build wealth more rapidly. As we bid farewell to these discussions, let us carry all the lessons learned and the wisdom gained into our own financial journeys. Like and subscribe to us for more financial knowledge. The more you know, the better decisions you'll make. There's a wealth of information out there. Make use of it. From the bottom of our hearts, thank you for joining us today. See you in the next video. Until then, take care.